Well, investors are wondering whether we've seen the worst of that European debt crisis or if it will spread. Joining us now from Berlin is Adam Posen. He is a member of the Bank of England's Monetary Policy Committee. He just took part in the German Conference on Financial Regulation. Adam, we're so glad to have you with us. So is the worst over?
Well, Deirdre, I hope it is, and they've done certainly the things necessary to stop a panic, and you're speaking about bond yields being very low, which is always a good sign if you're a central banker. That's a sign of calm. I mean, the structural underlying issues in the euro area still have to be confronted, but the idea of the immediate sovereign debt problem, I think, has been put in hand.
Adam, the immediate problem of sovereign debt has been put in hand. We do see, that's what you just said, we see the euro trading at about $1.23.5. It's well off of its lows, the ones we saw yesterday. To you, is that an indicator at all that the crisis, the worst of the crisis, is behind us? Or does that have more to do, say, with Swiss National Bank intervention yesterday?
It's probably both. Erik, I try not to comment on day-to-day or even week-to-week movements in the exchange rate. I like to remind people it was less than 2 years ago they were saying the euro was going to overtake the dollar and supermodels wanted to be paid in euros, not dollars. You know, let's stay calm. If the euro were to continue sliding for another few weeks, that would be something different, but there's no reason to think it will.
Adam, you have long been an advocate for fiscal stimulus in Japan, in the United States, but the rescue plan for the euro calls for severe budget cuts in Greece, in Portugal, in Spain. Is that the right approach? Does that introduce some risk into the system? Or perhaps should the Germans be thinking less about financing the South and more about subsidizing the South of the Eurozone?
That's a good way to phrase it. I did advocate stimulus in the U.S. and Japan in the 90s, and that was for two reasons. First, it was the immediate impact of the crisis, and it was right that European economies responded to the worst of the crisis in 08-09. Second, though, what's key about Japan, Berlin streets, what's key about Japan and U.S., different from, say, Portugal or Greece, is they are large economies with lots of domestic savings and with relatively closed economies. They had room to do fiscal stimulus in a way that a Greece or a Portugal or other peripheral economies do not. In fact, even the UK has more limits on its fiscal spending and less effect from its fiscal spending than Japan or US would. So all I want to say is there is reason to think that you can't do as much fiscal stimulus if you're a small open economy as U.S. or Japan, and it will hurt to take it back, but it's better than the alternative, which is driving up interest rates.
One thing, Adam, that Erik just touched on, of course, is this idea of the richer countries in the Eurozone being to the north, the poorer ones in the south. Today you made a comment to a German magazine saying that the ECB's bond purchases are effectively a fiscal transfer. Is this the best course of action right now?
No. I mean, what you want, ideally, Deirdre, is something like what Strauss-Kahn and the IMF have put forward and what I had been advocating starting a couple months ago, which is something that over the cycle tends to work against the imbalances within the euro area. And that would have meant not just that Germany and the Netherlands and Austria would be transferring to the poorer countries now, but the poorer countries would have had to be paying in when they were in boom state, and that would have balanced things better. The fact that the ECB is doing this, it's because they're intervening initially just to get rid of the panic and deal with liquidity, but they're insisting that they're going to sterilize all their interventions, which is another way of saying they're trying to close the gaps on the cross-border interest rates, not so much move the interest rates overall. And that effectively is a fiscal transfer. You're changing the relative price of debt in the richer countries from that of the poorer countries. That doesn't mean it's wrong, and it probably politically makes sense, but economically it's a pretty inefficient way to do it.
Adam, I have to ask you, we can't forget that you're a member of the BOE's Monetary Policy Committee. Do you share Mervyn King's view that what we saw in April inflation is just a temporary blip, or should we be girding for an inflationary storm?
I don't think we should be girding for an inflationary storm, but I and other members of the committee said pretty clearly in the minutes that were released this week and in the forecast that we view there are increased upside risks to inflation. Had there not been this breakdown in the euro area growth prospects, the props we should have seen coming, but certainly now we see, I'd be more worried. This is certainly going to have some disinflationary, some negative drag on the UK economy. We have to recognize, though, that we have a target. So far, we've been overshooting the target, and it is a little disturbing that when other countries' core inflation rates are descending, ours is not. I'd rather have this problem than be in deflation, so I don't think we're wholly wrong. And the basic expectations we're seeing on the gilt yields in surveys of financial markets and households suggest that inflation expectations are still anchored. But now we can't just say it's only about the downside. There is an upside.
All right, Adam, delighted you could join us. That is Adam Posen, a member of the Bank of England's Monetary Policy Committee.